Welcome to Baker Briefing, where we make the news make sense. I'm David Satterfield, Director of Rice University's Baker Institute for Public Policy in Houston, Texas. A year into the second Trump administration, what does the latest data tell us about the United States economy, which the president touted in a primetime address last month? And what can the numbers tell us, given changes in how economic data is collected following the government shutdown? I sat down with John Diamond, director of our Center for Tax and Budget Policy and the host of another of our podcasts from the Baker Institute, the Two-Handed Economist, to dig in. We discussed the latest data on employment, inflation, and GDP, as well as the impact of tariffs in all of this, and what we can expect for households and investors alike in 2026. Thanks for tuning in.
John, let's start at the top. For consumers, the economy feels at best confusing right now. Prices are still high, if not rising. Jobs, the latest unemployment numbers, feel less than secure. Interest rates remain elevated, even as certain market indicators were showing growth. From your perspective, how is the broad U.S. economy actually performing right now? And how solid is the data behind your judgment?
So the best way to put it would be the U.S. economy is stagnant. And it could go one of two directions. It could either fall off the cliff and we could continue to see a slowing economy, which we've been seeing the last 8 months, or maybe we're at a turning point and it could start to turn up and things could start to improve. And there's reasons actually to believe both of those stories. What makes it hard to distinguish and pick one of those stories is the level of uncertainty in the economy and the lack of data, good, hard government data that we've come to know and trust, that we know how it's collected, where it's collected from, and we can compare it to similar data that we had in the past. And so that shortage is hurting us, even though we have replaced some of that data with new data. But as is true with all new data, you're just learning it as you use it. It's not as solid.
So, John, let's talk about the new data. The latest out just within the last 24 hours shows that unemployment has risen to levels not seen since, I believe, 2020. And whether this is an ongoing trend or a brief-lived phenomenon, your views would be most welcome. Inflation, despite the president's original assertion that there was no inflation, remains at least above the nominal 2% rate and closer to 3%, according to most market indicators. So where's this all going? And more important than where it's going, why, John? What's creating this?
So that's a lot to unpack. So let's start with the labor market. So the latest data shows an unemployment rate at 4.6%. We added 64,000 jobs, which is a positive, but definitely on the low end of the positive spectrum. It was more than economists expected. So in that sense, it was more positive than we expected. However, remember, we took a month off in between the September data and the November data. And so we really need to kind of get into the nuts and bolts of how the data is collected. And so when we think about the employment data, we think about it in kind of three areas. There's the household survey, which is just a survey of households. There's an establishment survey, which is a survey of firms. And so from the household survey, we learn all kinds of interesting things about how different households with different characteristics are doing. What are they employed? Are they not employed? So forth. From the employment survey, we learn about wages, wage growth, what kind of sectors are doing well, which ones aren't. But then there's another part that you have to be aware of, and that is when you're predicting, labor outcomes in the market, because you can't survey firms that either just recently opened or just recently closed, you have to estimate what's called birth and deaths of firms and how that affects employment. And that is where there's a lot of uncertainty. And it really is the part of the labor market that we've been getting wrong over the last 2 years, probably going back to COVID. I think it's really changed the dynamism of the economy. So, all that to say, uh, what we have right now is a labor market that has been in a complete standstill for 8 months. Uh, the number of jobs is about the same. 3 out of the last 6 months, employment has gone down. Overall, the level of employment has been relatively steady. And so we're kind of waiting to see, are we going to stay on this flat, stagnant employment level? Are we going to see a downturn, or is it going to swing up? Now, the lack of data over the last 2 months has made it hard. For instance, the 4.6 unemployment rate for this month, technically that's an insignificant number. Because we didn't have the data in October and because the sample size was smaller, the way we usually estimate that number had more variance. We had less information about uh, what causes that number. And that means that for a really small increase in the number, the statistics behind it just aren't pure enough to say we really put a lot of confidence in this number. And so, I think we need to take that number with a grain of salt, as do we with some of the other data. Like, I don't think the 64,000, we should put a lot of hope in that number. And I think I can support that with the Fed chairman's most recent uh, discussion after they lowered interest rates by 1/4 of a point. He pointed to the fact that uh, the current government labor market numbers may be overestimated by as much as 60,000 jobs a month. And part of that draws from the last 2 years in August when we've revised job growth down by about 1 million each year. And that goes back to this birth and death model and the problems in estimating new jobs. All of that to say, we're left in a world where we really just don't know.
So, John, you mentioned the Fed. We really don't know. It means the Fed really doesn't know. What is your view of the interest rate cuts that have been implemented to date? And where, in your view, should the Fed go next?
My view is that the Fed has done a pretty good job in the last 6 months. So the Fed has a dual mandate. On one side, they've seen the labor market slowing. On the other side, they've seen persistent inflation at around the 3% level, so about a point above their target rate. That puts them in a really tough bind. So which target do we want to try to hit? And I think for the first few months of the year, they were sticking to we need to maintain our commitment to price stability. And so they were hesitant to bring rates down at all. But starting with the May and June employment reports and the revisions to those, I think that really changed their view, and they switched from a price-focused or putting more weight on stable prices and acting more to make sure we have stable employment. And I think they've made the right call up to this point, and I think they would be very wise to kind of wait and see a little now, at least until the data gives us more clarity.
When should that be, John? We talking about January, February?
I think, getting away from this government shutdown, which introduced some inconsistencies into the data. I think we need January data will be a little more solid. definitely by February, we can feel pretty good that we're back on track in terms of quality of data, and we'll be back to having the data that we're used to make these decisions. Now, we will have better data. Hopefully, the data is more enlightening than it's been, because even when we had data before the shutdown, I would say data was best described as mixed signals. One signal would be a positive, and the following day you would get a negative. And so it was really hard to feel confident in the direction of the U.S. economy.
John, we've talked about this before in other contexts, but does 3% or approximately 3% inflation concern you?
Absolutely. 3% is too high. The long-term effects of 3% inflation are very negative. We shouldn't wipe those away, and they especially hurt people at the bottom of the income distribution, because you will continue to see, one of the positives we've seen in the first half of the year was that wages were growing a little faster even than the high inflation rate. But that has slowed down now. And whenever wage growth is stagnant, consumption stagnates, that will have an effect that accumulates on the economy as a whole. Growth will slow down. State and local governments will suffer. Households will suffer. And so I don't think we should accept a 3% rate. I think that's much more painful than people think it is. So I'm in the firm camp that we need to get back to 2%.
And so your view, John, is that 2% has not been fetishized as a target. It's a meaningful target, and it ought to be the goal.
Yes, that is my view. And I think partly, now if we went to 3%, we would need to see faster wage growth to go along with that. So in the end of the day, I want to see wage growth between 3.5% and 4%, and inflation running at 2%. And really, it's that delta that's important. I don't think 2% is just some number. You want inflation as low as possible. And the reason we chose 2% is because deflation is just as damaging as inflation. So you want low inflation, but you don't want it too low. Okay. But that doesn't mean, we know for a fact that 2% isn't too low. So to me, lower's better. So let's go to 2%.
Where's wage growth right now?
Well, it started the year a little faster in the 4.5%, 5% range. It's falling. And so right now I would say it's just above 3% to end the year, 3.5%, maybe 4%.
All right. So let's talk a little bit about the why of all of this. What is the role in all of what we've just discussed, the numbers of tariffs?
Tariffs play a very large role. So tariffs have introduced a tremendous amount of uncertainty in the economy. And they do it at the micro level. They do it at the business level. And so people that are actually, opening, starting, or running businesses have been unable to confidently make decisions going forward. And when you create that kind of fog for the job makers, they quit making jobs. And you end up with a very stagnant economy, one in which businesses don't hire new people, and one in which they really don't fire people either. They just kind of stand back and say, I'm going to wait until I know what's happening. And so I think that's the biggest negative effect of the tariffs to date. We do know that the tariffs have raised prices, and that's one of the things that has contributed to this stickiness of the inflation rate around 3%. The good news is that because tariffs are in place and they look like they may be becoming a little more stable, that will have two positive effects. Well, one, we can start being a little more certain in what the future looks like, and really about the downside, meaning increased tariffs. We're getting to a world where we can say, okay, it looks like we're going to have basically a 10% tariff on everyone, and with a ton of exemptions and a higher tariff on China. And so that will allow business decision makers to be a little more confident in their decision making. At the same time, because tariffs will not be going up, that the increase in the price level due to tariffs should be waning out of the system. And so going forward, those are two headwinds that should turn into either, you know, in the pricing case should turn into a tailwind, and in the decision-making case should be a non-factor.
Do prices go down in this model, John, or do they just stay where they are?
They just stay where they are. They're not going to go down unless the tariffs go down. Now, in a world in which we went back to, so if we're running I think right now we're running about a 15% average effective tariff rate in the economy. If we were to return to January 1, 2025, when we had around a 3% average effective tariff, then we could see price reductions that would come with the lower tariffs. But if things just stay as they are, you will not see any price reductions moving forward. You will just see less growth in prices, and it could be worth maybe half a point in terms of the inflation rate. So maybe the CPI growth would go from 3 to 2.5 in the first 2 quarters of next year if we actually hold our tariff policies stable.
There is a major fundamental to the U.S. economy, to the North American economy, negotiation already beginning on the MCA, the Mexico-Canada-U.S. agreement.
Correct. That is going to be really important for the U.S., as will another important decision. The Supreme Court could rule on the tariffs, put in place by the Trump administration fairly soon. And whereas they do have ways to implement these tariffs, if the Supreme Court rules against them, they can't do it as strongly.
This is using the 301
Yes.
authorities. So, John, unfair question for you. What way do you think the court is going to come down?
Having read the brief of the lower court, it's my opinion that the Supreme Court should rule with the lower court. Their reasoning was really solid. In my view, I am not a legal scholar, so take that with a grain of salt.
But you're a two-handed economist.
Yes. And I do think that the Supreme Court is going to uphold the lower court's ruling.
Which means all of the tariffs or some of the tariffs, depending on the way the authority was cited.
Yeah, just the IEEPA tariffs.
Exactly. That's the Emergency Powers Act, which was intended to be invoked in the event of a genuine national security crisis.
Correct.
Not as a tool in classic trade negotiations or trade balance resettings.
Correct. And I think there's a pretty strong case that the lower court made that was not constitutional. It didn't follow the law. And so I expect the Supreme Court to uphold it. And then there will be an interesting question. Refunds. And I have no idea that would.
Amazon and Walmart are already in line.
Yes, that's going to be a really interesting economic outcome if we get to go through it.
So, John, on the same subject, the administration cites the continuously growing figure of revenues from tariffs, which are now approaching $200 billion, I believe, since the administration took office. What's the actual role in the economy of those revenues? And are they real?
Yeah, they're definitely real revenues. It's, we've always collected tariff revenues over the course of history. They've been more and less important. So just prior to this year, we were collecting about 75 billion a year in tariff revenues. And after the administration imposed the new tariffs, we've seen that number go up. Originally they were stating numbers that we were going to collect 300 billion a year in tariff revenue, with all of the exceptions and exemptions given out by the administration. That number's been whittled down, and I think you're going to see something between, once we kind of settle into a norm, I think you would see around 200 billion.
Mm-hmm.
There's a caveat there, though, when you're talking about revenue. So if you collect 200 billion in tariff revenues, that's not a net revenue gain of 200 billion, because a tariff is a tax, and it's a tax on factor incomes, and those factor incomes would have been taxed under the income tax system. And so you have to have what's called an income tax offset, which when I worked at JCT and Treasury, we'd use the same thing. The income tax offset is usually assumed to be about 25%. And so we should adjust those revenues for that income
Quick
tax
question.
offsets, i.e. we would raise less income tax revenues because they're getting to write off the tariff cost.
Factor income is what?
Factor income is capital and labor income. So it's income paid to the inputs in the production process.
Okay. John, classic number we all pay attention to. GDP, growth relative to other factors in the economy, and the fear of pullbacks, which we're already, I believe, seeing in consumer demand because of presumably uncertainty in the marketplace. What's happening?
The latest data is actually positive on GDP. GDP's actually come in stronger than was expected for the year
Because of AI?
because of so let's go back to the labor market today. So labor market data came in, and there were two things that we're very used to. The 64,000, the gain in jobs of 64,000 was related to three sectors: healthcare and education, which has been the trend for maybe the last 2 full years, going well back into the Biden administration. The third sector was kind of a new sector that jumped into the mix, and that was construction. And that is 100% related to the construction of power plants and
data centers.
and data centers for AI. So yes, when you look at the GDP numbers, the glaring figure that sticks out is the increase and so if GDP is if we break it down to its components of C, consumption, G, government, and I, investment has been very strong of late, whereas government and consumption have been weakening. And so, yes, this is all being driven by AI. My view is that we are nowhere near the end of it. And we may be near the end of the private part of it. So there's this ongoing, discussion of, is AI in a bubble? And it may be, it may not. But the one thing that I think is that no matter whether, if it is in a bubble, it's a financing bubble, and that how do we bridge the gap between the investments we have to make and the revenues we expect to come in? So if there's a bubble, the problem is that we're making these really large investments, but the returns on those investments are too far out for the market to stomach well.
Mm-hmm. But you would argue, at least to date, this is not the same as the dot-com bubble.
It has a lot of similarities to the dot-com bubble. So, in the dot-com bubble, we invested a ton in laying fiber optic cables. And then it ended up that those things were not nearly as valuable as everybody had thought. It is completely possible that we make very large investments in data centers and energy, and then we find another way to do this. And all of this investment, like the dot-com bubble, turns out to be not very efficient. So that is one possibility. But I will say, jumping into your area a little bit on geopolitics, this isn't just a private industry competition. This is really a competition between the U.S. and China.
Absolutely.
And who's going to win this is extremely important. And I expect at some point the U.S. government's going to have to jump into this game in terms of supporting this investment just to make sure that we outcompete China in the race to develop fundamental AI. I could be wrong on that, but I don't think I am. When I look back at history and the developments of new technologies, this would not be the first time that the government had to jump in order to bridge the gap between the investments that need to be made and the eventual profits that will come from the asset.
John, we're approaching Christmas and the New Year. So your Christmas message for investors, your Christmas message for consumers, the average household.
So I'll start with the good news for investors. Fill your stockings. Looks like another great year in front of you.
I'm going to hold you to that, John.
I'm expecting, we are in a transformative time in the economy, and I do think that you're going to see a lot of growth in corporate values, as well as, the Fed is, in its last statement, the one thing, and in the last sentence of its last statement was a much bigger point than it was given in the news, was the Fed's return to buying U.S. Treasury bonds. That they deemed that the reserve system was needing or may need more ample reserves going forward, and that starting, from the time of this message forward, the Fed was going to be buying more assets and more short-term treasuries. We still face the problems with the debt. The Fed's going to have to continue to inject itself in the market. All of that is really good for asset prices. And so I've got, my view on asset prices moving forward is very positive. For the consumer, it's a very different story unless you own those assets. But for all of those that depend on wage income and other non-investment capital income, things don't look nearly as positive. The very nature of AI is, if you're going to pay for these large investments, you're going to need savings or productivities from something, and most of these are efficient, production efficiencies that save on labor income.
Which means jobs will not be there, including some jobs at pretty high end of technical training and education. That's a whole nother story.
Yeah. Well,
as
yes.
this comes on.
As it comes on. Now, I'm not a negative AI person that thinks, well, this is bad long term. Technology produces new opportunities, and we will see those. And eventually it will be very positive for workers. It will make them more productive. It will show up in higher wages eventually. But the transitions are always difficult, and they're always costly for groups of people, large groups of people. And so the benefits will accrue to some people, but as we've seen with manufacturing shifting overseas, there are very large costs that accrue to others. And I think we're going to see something on that lines over the next couple of years as we weave our way through this transition And this is probably decades of transition, not a couple of years. But as you get into that, new jobs start being created, but it takes a while for those new jobs to be created and for people to train themselves and to be able to fill those jobs. So for the next year, I do think we're going to, the labor market for the bottom 70% of the U.S. labor force, we're going to see tight growth. I think price growth will continue to be relatively high over at least the first half of the year. I'm hoping that by second half of the year, we can start to get back to the 2% range. And I think we're going to continue to see wage growth that is slowing. That doesn't bode well for the consumer.
And my final note, moving outside the realm of the economist, from the standpoint of U.S. politics, we got an election year coming up. And as the second quarter of next year unfolds and voters begin to reflect upon the classic question, are you better off than not in terms of your pocketbook, your household, than you were on election day 24? There's going to be some fascinating polling and some fascinating indicators, and we'll have to talk about those as they begin to unfold. People voted for President Trump for many, many different reasons, but nobody voted for policies that will leave them demonstrably worse off 2 years hence.
No, if you're right on that, and if it was Bill Clinton that said it's all about the economy, stupid. And we are well in that world. So the economy is going to be the single most important factor, just like it was in this last election. High inflation really impacted people and is continuing to impact people. And we're seeing it, outside of gas prices, which are low. Boy, a trip to the grocery store can be really eye-opening. And don't even think about going out to dinner because that's become absurdly expensive.
Yeah, don't think about drinking coffee because you can pay $12 a bag for it now.
Yeah, so on the politics, we'll see how that goes. I'm not very optimistic on it, no matter how it turns out, R or D. We've got a broken system. Something has to, at some point, our politicians have to, we've got to find a way to work together again and meet in the middle. And in my field, to actually pass sustainable budget policies, because our current budget policies are unsustainable at a very large level.
And the common wisdom in all of the discussions that I join in is that until the crisis, the real crisis, is at the doorstep, Social Security, Medicare, Treasury paper, a true crisis, not the imminence of crisis, that kind of bipartisan addressal isn't going to be possible.
You are probably correct.
John, thank you. We will have more to talk about as the new year comes upon us.
I look forward to it.
This has been Baker Briefing, where we make the news make sense. The podcast is brought to you by Rice University's Baker Institute for Public Policy, delivering nonpartisan, expert policy research on the most pressing issues facing the United States, Texas, and the world. Share your feedback and topic suggestions for us at bakerbriefing@rice.edu. This episode was produced by Corinna Zemung and Shannon Moriarty with production support by Kevin Young. You can find our other podcasts and the Institute's latest research and events at bakerinstitute.org. Thanks for joining us.